Well, kia ora ana tātou katoa, tēnā koutou katoa. Welcome everyone to the May 2021 Monetary Policy Statement. As always, I want to thank the Monetary Policy Committee members, some of whom are represented today. I think we've got 6 out of 7 in the room here today. All 7 were comfortable with us, by the way, so don't read anything into the absence of one. But thank you so much for all of the hard work that went into the decision making that's reflected in this document, and of course to the staff of the Reserve Bank who have been working very, very hard to ensure we have our projections and the material that you've had in front of you today. What have we done? Well, today, the Monetary Policy Committee agreed to maintain the current stimulatory level of monetary conditions, and that is in order to meet our consumer price inflation and employment objectives. We will keep the official cash rate at 0.25% and the large-scale asset purchase and funding for lending programs unchanged. The global economic outlook has continued to improve with ongoing fiscal and monetary policy support underpinning this global strength. New Zealand's commodity export prices have benefited from this rise in global demand, but divergences still remain in growth both across and within regions of the global economies. I'd say these divergences remain significant. The sustainability of the global economic recovery still remains very dependent on the containment of COVID-19. Here in New Zealand, the near-term economic data continues to be highly variable, and we expect that to be as such over the next few quarters at least. While economic growth in New Zealand slowed over summer months, largely as we expected, that was largely following a very strong rebound in the December quarter. The aggregate level of employment has proved to be very resilient, and construction activity remains very strong. And of course, sitting there, we have significant fiscal spending continuing to support domestic economic activity. Of course, there's always a however. The tourism-related business activity in New Zealand continues to be affected strongly by the absence of international investors. The recent opening of international trans-Tasman travel is expected to only partially offset the loss of export service revenues for these sectors. Also, the extent of the dampening effect of the government's new housing policies on house price growth and hence, of course, overall economic activity will also take time to be observed. So these are relatively fresh policies, and we put our own LVR lending restrictions in that broader bucket. Overall, our medium-term outlook for growth remains very similar to the scenario we presented in the February Monetary Policy Statement. I'd have to say I'm relieved by that relative to the last 12 months or so we've come through. Confidence in this outlook is rising, and really that's more related to the fact that some of the extreme negative shocks or possible shocks are waning as the COVID vaccine progress rolls out internationally. We remain cautious, however, given this ongoing virus-related restrictions and global economic activity. The unevenness of current economic growth across sectors within Aotearoa New Zealand, and of course the still weak level of business investment. We are seeing some good tentative signs of business investment on the rise, but they are early signs. There are a range of international and domestic factors currently resulting in rising business costs. These factors have been well talked about in international and domestic media. They include disruptions to global raw material supplies, higher oil prices, and a lot of pressure on shipping arrangements and shipping costs. Our view is that these price pressures are likely to be temporary, and they are expected to abate over the coming year. The committee noted that the medium-term inflation and employment would likely remain below its remit targets in the absence of a prolonged monetary stimulus period. We agreed that while the low interest rate environment has supported house prices, other factors such as the recent tax changes, the growing supply of housing and the lending restrictions are providing offsetting pressures. On balance, in consensus, we've decided to maintain the current stimulatory monetary settings, and we are confident that consumer price inflation will rise to near the 2% midpoint range of our target, and that employment will rise to be at its maximum sustainable employment level over the projection period. Having said that, meeting these requirements will necessitate ongoing considerable time and patience. Me taki ma'ata. We are open for questions. I have with me, of course, Christian Hawkesby and Yung Ha. Thank you.
Bernard Hickey from the Kaka and the Spin-Off. Governor, could you give us an indication of how much you have increased your forecasts for the OCR, given we now have a forecast for the OCR reinstated and we don't have a forecast for the unconstrained OCR to compare it with?
I think it's excuse me, think about our projections, what we've had before. I'm not sure whether you're going to be comparing apples with oranges, to be honest. What we've been talking about before have been a basis of scenarios. Scenarios because of the extreme degree of uncertainty that all central banks, in fact all economic agents, have been operating with over recent quarters. Where we are now is we feel comfortable to be using a projection of OCR simply as a guidance for how we think the interest rate outlook would pan out if and only if the economic environment pans out as anticipated. So comparing scenarios with our current central prediction, I would be lost in explanation. I'm sorry, Bernard.
Janae Tibshirani from interest.co.nz. Could you please expand on why you see inflationary pressures to be temporary, and I guess expand on any risks that these pressures might not be sort of as temporary as we think?
No, very good question. We've spent some considerable time within the actual monetary policy statement, and really as much to explain to audiences and to remind ourselves that, of course, our task is to maintain stable inflation in the consumer price index on average through time. Meanwhile, there's going to be a lot of relative price shifts for goods and services going on all of the time. That is just the nature of any economy. At present, we can identify some very significant relative upward price shifts because of largely one-off factors that we can point at, whether it's a rise in oil prices, which has already happened, current shipping constraints and potential rise of prices, which will be resolved, and some other one-off, I'd say, administrative cost type adding to it. So these can kind of fall into, I'd say, three simple camps: prices that go up and then come back to where they started from, prices that go up one-off and stay at a higher level, or prices that go up and reverse in total. And sitting across the relative prices we're looking at, all three of those things are happening to various prices. For us, we would be wrong to try to react to near-term relative price shifts because we don't have the tools for that and it's not in our mandate. Rather, we'd be saying we recognise those price shifts, and our main concern is that a relative one-off price shift doesn't lead into generalised inflation pressures, i.e. that everyone tries to pass it on to every other good or service and everyone else on average through time. In other words, inflation, medium-term inflation and inflation expectations remain low and anchored. We are confident, given the nature of the one-off shifts in the prices that we are currently observing, the global spare capacity that's still out there in the world, a long history of low inflation that we've had globally, and well-anchored inflation expectations that the risk of a one-off price shift turning into generalised inflation remains low. As central bankers, we will always say it doesn't remain zero, and that is why we will continue to monitor, but we are not, we are very explicit. We believe these will abate. I'll try to be quicker in the next answer.
Matthew Brockett from Bloomberg. Could I just ask for a bit more explanation around the forward track, which you've reinstated? You're forecasting rates rising in the second half of next year while inflation is still below target. So what is it that you would, I understand it's all conditional, but what is it that you would need to see happening in the economy to see you pull that trigger on interest rates?
Thank you, Matthew. And I'm going to pass on quickly to Christian. I'll just say at the opening part of it, we're always forward-looking when we're setting interest rates. For us to be altering interest rates, it's based on a forward-looking view on how we see economic activity unfolding. This is why we have the official cash rate projection in there, conditional on our economic forecasts that are also included in there. So what we're looking for is much and varied as outlined in our forecast, but I'll let Christian be a bit more tangible.
No, I think that's right, that for us it ultimately boils down to our confidence in achieving our mandate. So where is it that we can set interest rates to have confidence that we're achieving our inflation target and our employment target? And the key message from the statement today is that we are going to need considerable time and patience to do that, and that's why our OCR projection is reasonably flat for some time, but there will come a time when that confidence grows. Really important message is that OCR track that we've published is not forward guidance. It's a conditional projection based on a whole lot of assumptions that sit under that, and those assumptions we'll revisit every 6 weeks, every 3 months.
So I'm not sure that was any more tangible. It was very good, Christian. But Yung, what are some of the main big uncertainties or assumptions that are embedded in the?
Yeah, I mean, we still have a view that a working assumption is that board is open early 2022 and a gradual pickup and return of international tourism and international services. That's still a big unknown, and basically, will businesses continue to invest and with confidence as the economy opens? So those are things that we're watching and waiting.
And can the spare labour resources we see out there in the economy find new homes to be employed?
Stephen Wright from the Wall Street Journal. I guess the tone of the statement is a little different from the previous monetary policy statement insofar as you have reinstated a cash rate profile and commented on greater confidence in the outlook. How would you characterise that shift? Do you see that as being tentative or quite a definitive shift from your last monetary policy statement?
I won't comment on the tone, that's your perception, but I would say how we're operating, we're very explicit to say that we have been dealing with what I would call very skewed risks to the downside based on the COVID-19 environment that we operate in. We're saying some of the more extreme risks are now off the table, touch wood. Why I say off the table? Because economies or countries have got better at managing outbreaks and also the global rollout of the vaccination. So, what was a skewed distribution is now becoming more balanced. But around that balanced distribution, of course, is a very wide confidence interval based on all of the things we discuss in this document. But standing here in May 21 relative to May 20, I'm feeling more confident.
Sorry about that. Ben McKay from Australian Associated Press. Firstly, this is the first Monetary Policy Committee meeting that has had to take into effect Grant Robertson's edict that you need to look at housing prices. Can you explain actually how that decision making has gone and how it's worked and how it's fed in? And secondly, how much stock do you give to Treasury's forecast of price rises in housing peaking at 0.9% in the June quarter next year?
Wonderful, thank you, and welcome. It's critically important, and I'll say it very quickly. The Monetary Policy Committee has to explain the impact of their decision as they see on house prices. So house prices do not enter our decision making at all in a formal sense in the setting of today's decision. They are involved in the economic projections because they are a key asset, they have wealth, so on and so forth, construction activity, but the actual house price itself is not a target or part of our remit. That's really important to understand, and I know it's been a misperception globally. Likewise for our Financial Stability Committee, the other arm of our policy, or one of the other arms of our policy, there we have to have regard for house prices when setting macroprudential tools, and we talk about that in our Financial Stability Report. In here, our projections, I think forward projections, I will caveat for what they're worth because these are asset price projections which are wildly uncertain, are that house price growth slows significantly and soon. And I believe that is very consistent with the Treasury's projections, and I will say they have been done independently. Why are our growth rates slowing? Because most of the factors that are driving house prices are either waning or disappearing, having downward pressure on what we would call a sustainable level of house prices. We've seen significant tax changes for housing investment. We are seeing significant supply in housing, increase in housing supply with the construction activity that's going on. We ourselves have added and put in loan-to-value ratio lending restrictions. I note at 3 p.m. today, sorry it's all happening while you're here, that the April month stats have come out and they are indicating that it's biting as anticipated. And population growth has been slow. So a lot of those longer term drivers of house price supply and demand are suggesting a period of subdued house price growth. By subdued, we're projecting zero quarterly growth rates at the level of house prices basically go sideways from the middle half of this year for a period of time.
Hamish Rutherford from the New Zealand Herald. Just to go on to that, you as you say, you expected house prices to drop almost to zero and then to return to low levels of growth continually. What leads you to that confidence rather than the range of measures, including your own, that you don't send house prices from their elevated levels lower?
Yeah, I mean, very, very good question. Thank you. The real challenge for us is our economic tools are best at talking about longer term, I would say, fair value, sustainable rates of asset prices. How the actual price actually moves around some measure of longer term fair value is impacted by a lot of additional things, in particular investor demand, fads, fashions, cycles, fear of missing out, all the things that drive asset price markets. What we're talking about is that we see the fair value of house prices, the sustainable pressure on there, having downward pressure on those drivers at present. Now remember that these fundamental factors, population growth, income growth and supply, increase and alter through time. So the price doesn't always have to be, prices by staying still for a while can eventually bring the current price and what we would call sustainable back together again. It's only the future will tell how prices evolve relative to our measures of sustainable fair value.
Hi, Lynn Grieverson from Banking Day. Do you think that house prices as they are now, and presumably as they will stay if you're not predicting them to drop, are sustainable, and how do you define sustainable?
So we've spent a lot of time in our Financial Stability Report. I'm saying we are kind of wearing the other glove, and as Deputy Governor Jeff Baskin spent a lot of time, as recently as a fortnight ago, discussing the framework around which we consider sustainable house prices. And in the simplest terms, it is where we believe house prices settle given the underlying supply and demand factors for houses, i.e. population growth and the rate of growth of house building. So that is a fair value medium term. Now, you can have the same for almost any asset price. There is some kind of fair value term for an asset price, and houses are no different. It might be to the owner-occupier around the cost of owning a house versus renting a house. It might be for the investor's perspectives, the worthiness of investing in a house versus some other asset group in their portfolio. They all come to the same underlying construct, which is what are the supply and demand drivers determining whether this is some sustainable level of house prices. Meanwhile, in our day-to-day lives, asset prices go up and down and all around the place relative to those fair value prices. And we have come through a period where we could say the growth rate in house prices was unsustainable. What does it mean for the level of house prices? Well, relative to fair value, we're saying we believe there's not a lot in it for house prices to continue growing like they have done. I hope that helps.
Do you believe the OCR forecasts
Yes.
published today? Yeah, you do believe them. That's good. Do you think they will take some of the heat out of the housing market?
In our, in our monetary policy remit, as I mentioned earlier, we have to say how we, what we think our policy decision, what impact that has had on housing. And we still believe with interest rates and the stimulatory level, we are putting upward pressure on the housing market. We are encouraging investment, we are encouraging spending. Low interest rates mean that, mortgages are affordable, so on and so forth. But what we're also observing is all these other factors that are putting downward pressure. Through time, if the interest rates rise as in this projection, then yes, that would be taking some of that stimulus out of the housing market, and we would be putting downward pressure on spending and all those things. That's the natural swing and roundabout of what we do. This is also why we've been really, shouting from the pulpit around, think in the long-term sense when you are considering mortgages, when you're considering buying. Don't get excited by the current mortgage rate. Think about what mortgage rates might look like on average through time, and how does that feel for you as a buyer or investor in housing? Because globally, interest rates are very low and certainly below what we would consider a neutral interest rate globally. They're there deliberately because that's what central banks are doing. So be wary around your ability to service a mortgage.
And just a financial stability question, I guess. Does the reinstatement of LVRs and also the tax policy changes, do those measures together reduce the potential need for debt-to-income restrictions?
They are certainly working in the direction of dampening house price growth by restricting investor access and upward price on pressures. So in that case, if you wanted the DTI to dampen it, then they are doing some of that work for them. We put in our most recent financial stability report a pretty thorough discussion around what the various instruments do and what they're most effective at. We ourselves still think some type of debt servicing restriction tool for us is an effective and efficient tool. So just, if, for example, current asset prices, houses were declining, that doesn't mean there wouldn't be future events. It was an if.
You spoke about central banks around the world keeping OCR low. Do you think, though, that the retail banks have been doing enough to pass on those conditions to consumers?
I'll pass on to our market experts, either Christian or Jung.
Yes, so there's really been sort of little change, we would say, in total since our February monetary policy statement. So we've had term deposit rates fell very significantly through the course of last year, and they've stayed low since February. Within mortgage rates, we've had some of the longer-term mortgage rates go up, but some of the shorter mortgage term rates go down. So in net, we think that the overall amount of stimulus through to the retail market is similar to what we were providing in February.
So a fair reflection, and we've been very comfortable with the way that our additional monetary policy tools have been working as well. Is that?
Giles Beckford, Radio New Zealand. To what extent did last week's budget and the fiscal measures included in that, in particular, say, benefits, have any bearing on your thinking, or will it affect your future thinking, perhaps?
We were fortunate enough with the timing of the budget that they are, to the best of our efforts, incorporated in what you read today. So the most recent announcements around transfer payments and investment and spending decisions from the government are incorporated in our projections. That does give us increased confidence that fiscal policy remains our friend in terms of doing the lifting on economic spending for some time to come.
Hi, Praveen from Reuters. If you look at these OCR projections, it would appear that there might be a hike in the second half of next year, and that may be before many other central banks around the world hike rates given conditions and COVID. So would that is there a concern that will push up the dollar, or the market would react to that?
Yeah, thank you. I mean, we. The exchange rate is driven by really inflation differentials between countries over the long term and relative productivity differentials. So, we think by staying on top of New Zealand inflation relative to global inflation, then that is the best, I suppose, addition we can do to financial monetary policy stability, and not creating unnecessary variability in the exchange rate, interest rates and outputs. I will just, and I know too often it falls on deaf ears, these are highly conditional projections. You're talking about the second half of next year. Who knows where we'll be by then. I think we can wrap it up there. Yeah. Well, it's one to go.
Do you expect to taper or slow down your buying of bonds? Do you think you'll still be buying bonds into 2022?
Our current plan is that the large-scale asset program and funding for lending program remain in place as stated. We talked about through to June 2022, so that's well articulated. And
what's the plan for bond buying after June 2022 outside of the LSAT?
That's really going to be a function of what we need to do with monetary conditions at the time, and then, of course, which instruments are most favoured or needed at that time.
A very high proportion of mortgages are on very short terms. How is that sort of playing into your thinking about the sensitivity of the economy to any future interest rate changes?
Yeah, it's a great question. I mean, I remember standing here a couple of years back being told that monetary policy has very limited influence on any economic activity. I would say at the moment it has a very heightened focus on it, in large part because of the nature of what has been driving economic growth recently, which has been increased debt positions, driving higher asset prices, which are all highly interest rate sensitive. So we expect to get a reasonable bang for buck, whether it's any different than usual through history, to be determined. But, that's why we keep putting that warning out. Think about long-term average interest rates, not what you are currently being offered. Thank you very much for all of your questions, and thank you again to the staff at Monetary Policy Committee. Kia ora.